Frequency Podcast Network. Stories that matter, podcasts that resonate.
Hey, it's Jordan. Sometimes we have the luxury of time when putting together these episodes. Sometimes news breaks, news that matters to your wallet, and we want to get it to you as quickly as possible. Hence, our decision to air today's big story episode on In This Economy. Why? Because for the first time in a long time, interest rates are going down. What does that mean for you? I don't have much to say here other than this. Finally.
After the fastest run-up in interest rates in Canadian history, the Bank of Canada has finally cut rates for the first time since the start of the pandemic.
Monetary policy no longer needs to be as restrictive and lowered the policy rate by 25 basis points to 4.75%.
It has been 4 years since the Bank of Canada actually lowered its interest rate. And when that rate first hit 5% last year, it was the highest it had been since March of 2001. It's been tough. You could almost hear the collective sigh of relief on Wednesday morning from anyone with a mortgage, a car payment, or a line of credit, or really any kind of debt. But should they be waiting to exhale? This is 1/4 of a percentage point. How much of a difference will it actually make to Canadians who are struggling to afford to keep up payments on their debt? Is this the first big move in a long-term plan to ease pressure, or a trial balloon that could quickly be popped if the economy doesn't respond? I'm Jordan Heath Rawlings. This is The Big Story. David McDonald is a senior economist for the Canadian Centre for Policy Alternatives National Office. Hey, David.
Hello, thanks for having me.
You're welcome. As I said in the intro, finally, I'm glad to be talking to you about this.
Finally, we're seeing some rate cuts. Maybe a little late, but maybe better late than never.
Give us a little context around interest rates in Canada. How does the recent period of what we've all been feeling as high interest rates compare, historically to those periods?
Yeah, I mean, the interest rates that, 5% overnight rate is actually pretty mid-range in terms of the overnight rate. If we look back post-Second World War to today, it's actually pretty similar to the levels we were at just before the Great Financial Crisis in 2008. For much of the period from the 70s through the early 90s, rates were at about 10%. They actually hit 20% in the summer of 1981.
Oh, wow.
So we're sort of mid-low range in terms of interest rates, historically speaking.
But as I understand it, it's been almost 20 years, or more than 20 years even, since the rates were as high as they've been over the last several months, right?
That's right. In the period between 2009 and 2022, they were zero. And that is completely unprecedented in Canada, but also internationally. They were at what's called the zero lower bound, quote unquote, where monetary policy ceases to be relevant. So the Bank of Canada can do nothing else to encourage economic growth. They basically make money free, in essence. Take money, go buy a house, and hopefully we'll encourage economic growth as a result. And that went on for, more than a decade. Over that period. Now, that changed pretty decisively as we started to see inflation pick up. And one of the reasons why 5% seems astronomical, even though it, historically speaking, isn't terribly high, is how quickly it happened. So we went from 0 to 5%. We went from 0 to hero in about 17 months. That speed of increase over that period, 17 months, about a year and a half, has really only happened once or twice before. It happened once in the late fall, early winter of 1979, and happened again in the summer of 1981. In the summer of 1981, rates actually were up 10 percentage points compared to a year and a half earlier. This is the time where they hit 20%. We got close to that scale of increase in the spring of 1989, where rates rose for 4.3%. We have to remember that important things happened after 1981 and 1989. The housing market was utterly crushed for a decade after both of those.
Right.
Both of those were followed by major recessions. The other thing, too, to realize is that rates are relatively low, historically speaking, even at 5%. But other things had adjusted when rates were higher. So the cost of a house was a heck of a lot lower in the 70s, 80s, and 90s when interest rates were 10, 20%. And that's one of the adjustments that you would expect to see with much higher rates is lower house prices and also, lower costs for other things. We have seen some decrease in house prices as a result of these very high interest rates, or this big increase rather in interest rates. And house prices down about 15%. But we haven't seen the housing market utterly crush in the way that it was in previous times around when we'd seen rate hikes that had happened this quickly.
You mentioned that the rate was at 0 not that long ago. How did that low cause Canadians to feel the pain a lot more, I guess, when, to your point, even a modest rate, a historically modest rate of 5% is hit?
Yeah, I mean, technically it was 0.25% in terms of the overnight rate, but the bank considered that as low as it could go. There was some experimentation in Europe with negative interest rates. So, you're paying your mortgage payment and in essence, the bank pays with you a little bit. And so you end up with every single dime of your payments going towards principal and then some. The effect of this and the goal of very low interest rates, of reducing interest rates, the goal of monetary policy is to encourage people, households, and businesses to take out debt, spend that debt in the economy, and drive economic growth. That's the point. And when you're at 0, you can get a lot more leverage in terms of a much bigger mortgage, in terms of businesses taking out, in essence, interest-free or close to interest-free loans.
Right.
And so you get a huge buildup in debt, which is exactly what we saw over this period. Huge increase in house prices because now all of a sudden those monthly mortgage payments, so much more of that monthly mortgage payment is going towards principal instead of interest when interest rates are so low. And you've got a long period of it. And so you see huge increases in house prices, but at the same time, huge increases in debt. And this was of great concern to folks over this period, including the Bank of Canada, which is that you can certainly increase economic growth, but you do it by heavily indebting the household sector. And the chickens came home to roost. You see this huge increase in interest rates. So now all these big debts that were manageable at 0% maybe become a lot less manageable at 5%. And certainly the house prices that were manageable at 0% become a lot less viable at 5%.
But as you mentioned, the housing market hasn't really collapsed in the way we had seen previously, at least not yet. Why is it so resilient now compared to previous periods of high rates?
So it does take time for the housing market to adjust. Certainly volumes have collapsed. So we're just not seeing the same level of transactions. People just aren't selling their houses because they can't get what they think they might expect. That hasn't yet translated really into prices. Maybe it will. It may be a matter of time before that finally translates into prices and people do have to move. And so they're going to end up selling their homes and reduce prices. Certainly this reduction in the interest rate today could have some impact on the volume in sort of the spring sales season. The other piece is that, look, we have over 900,000 new people entered the workforce in just the last 12 months.
Right.
Thankfully, 600,000 of them got jobs, lending credence to the very strong labor market that we've had over this period has accepted a lot of new workers. And that is going to push the other way. So that's going to put some pressure on house prices. Investment in the housing sector has become, an important means of Canadians for increasing their wealth, increasing their retirement savings. You don't sell a house when you move it, you keep it and you rent it. So much so that in big cities like Toronto or Vancouver, a third of the residential housing stock is investors. Certainly there's some part of this that's real estate investment trusts that are buying up some of the big buildings. They have a specialized tax break and so on. A lot of it, though, is just, regular folks that are using housing not as a place to live, but as an investment, bringing additional leverage to the market, which means that house prices are going to stay higher than if those folks, invested in the stock market instead of continued using housing as an investment tool.
This rate had been stable for many months before this current decision. Is that usual? And why has the bank waited so long to make this cut? I remember having this conversation last December. Are they going to be ready to cut in January? I don't think that was the first time that I've had it because people are really struggling.
Yeah, it's not that unusual for the rate to stay the same for a period of time. We think of the Bank of Canada as fine-tuning the economy, and this type of language makes it into Bank of Canada communications. In reality, monetary policy has huge lags. So changes in the overnight rate that are being made today aren't going to be fully felt for 18 months to 2 years. So we're making policy for 2026.
Right.
And so it's one of the reasons why rates tend to stay the same for some period is that you are attempting to make these changes longer term. When it comes to the bank not cutting sooner to help people out with the affordability crisis, in essence, the bank doesn't care about the affordability crisis. That's not their role. Their role is to target inflation at 2% within a range of 1% to 3%. Those goals are given to it by the Government of Canada, which owns the Bank of Canada. And they are to do that with interest rates exclusively. So there's a box, and they're in the box, and they're operating in the box. They are concerned about things outside the box, but in the end, they're operating in the box, which is they want to bring inflation down. They want to do it with interest rates. And the basic idea here is that you end up spending so much on mortgage and interest costs as a consumer, as a worker. Incidentally, those mortgage interest costs are part of the CPI inflation index. So they actually push inflation up, right? As interest rates go up, these parts go up. But the idea is that you spend so much on them, you have nothing left to spend on other things, or you have fewer dollars to spend on other things. And the rate of increased prices and those other things goes down. And then on average, and that's what inflation is, the average of these price changes. On average, things go down. And in particular, the bank is concerned about persistent or long-term inflation. Clearly, we don't want inflation at 20% for years on end. There's very little empirical evidence that 3% inflation is better than 2% inflation or 4% inflation. But the concern of the bank is, quote unquote, long-term inflation. This is built on this premise that workers and consumers and their excess spending is what's driving inflation. You during the pandemic potentially lost your job and you got CERB. And because you received CERB, you've got this extra money and you're spending it in the economy. The details of the inflation that picked up in 2020, that hit its peak in June of 2020, really challenges this assumption that it's consumers and workers that are the primary drivers of inflation. Big drivers of inflation in 2022 were supply chain backups. This creates temporary monopolies where you've got the corporate sector that doesn't see competition because the competition can't import goods. And so you're in a position where you can raise prices like you would in a monopoly. It's temporary. The supply chain issues have been sort of sorted out since then. The other key thing that was happening in 2022 was key input prices saw massive hikes. And these massive hikes in these key inputs into supply chains ricochet through those supply chains over the course of 2021, 2022, 2023. Think of things like gasoline and diesel, big increases in those costs due to the war in Ukraine.
Right.
These led to record corporate margins, corporate profits over this period. How do you control the prices of these key inputs? How do you clear supply chains? That's not in the box, right? Interest rates don't help you there. And so the Bank of Canada attempts to do what it can do on inflation on these interest rates, even though these big drivers had little to do with consumer spending and everything to do with, if you're a company at the right place in the supply chain, you get a temporary monopoly, you get massive corporate profits, and you laugh all the way to the bank. And, this is one of the big results of inflation where a lot of this money went, is ended up as corporate profits.
We talk about it like it's a huge news story today that the Bank of Canada made this decision. It's a quarter point. It's going from 5 to 4.75. How will Canadians actually feel this? And how much does it matter in the grand scheme of things?
In terms of the immediate impact, if you have a variable rate mortgage, whether it's fixed payment or variable payment, you will see this impact immediately. This is the one group that will see this change immediately. Now, as you say, it's not a massive change, and you're still paying far more than you were paying on your mortgage in January of 2022. Outside of that group, it's going to be relatively limited in the short term. So for other folks that have mortgages, those are going to be on a fixed interest rate. And so, if you have to renew in June, then this is going to help you a little bit. But it's worth pointing out that if you're renewing in June and you're on a 5-year term, you had a very low rate and you're going to have to renew a 4.75 up from, whatever the initial rate was, 2% or something like that. That's a big increase. Mm-hmm. That's slightly better than renewing at 5. But in any event, you're just still going to see a huge increase in your mortgage costs. for folks that were unlucky enough to have to renew their mortgage a month or two ago, there's been a pretty decisive shift away from variable rate mortgages towards fixed rate mortgages because people don't want to bear the risk of further increases. I mean, they got stung once and they don't want to get stung again. They're locked in for shorter terms. I mean, we're seeing not 5-year terms, more say 3-year terms. And so the impact of this particular change, you don't see it for a year or two because of all these effects. People are locking in rates. And this is happening on the business side too. And businesses take out loans as well. And they try to fix those interest rates as well. They don't want to get stung by big swings in interest rates. I think the bigger question is whether this is part of a trend. Is this the first cut? Are we going to see another cut in July and other cuts in the fall and so on?
Yeah.
And then you see a bit of a bigger impact. But the broader point here is that interest rates are just going to be higher now. They're not going to go back to zero like we saw, for the 2020 through 2022 period. They're probably not going to be 5%. Maybe we're looking at more like 3% in terms of long term, unless there's a recession, in which case maybe we'll go back to zero. But it does seem like, at least at this point, it is possible for the economy to sustain 3% inflation without seeing a recession. Certainly, we haven't seen one so far.
What if you're someone who is trying to sell a house right now? Is this good for that side of the market? Will it increase activity?
It probably will. I think we have to think of not only this particular small change in the overnight rate, but the potential for people to understand that this kicks off a trend of decreases in the overnight rate and mortgage rates in general. Volumes are way down in part because people expect their house price to be more than people are willing to offer for it. And so therefore it doesn't sell. And so volumes are down. Mm-hmm. Decreases in mortgage rates will give people more leverage. You can afford a little bit more if the mortgage rate is lower. There's some expectation that this is going to explode housing prices. They're going to go way up. And so if you're a homeowner, you're going to make a lot more if you're selling your house. I'm not sure that that's true. I think it's going to increase volumes. But to say it's going to increase house prices substantially, there's still half of mortgage holders who haven't yet renewed at these higher rates. We're at the break-even point right here in June of 2024. Half of mortgage holders were variable rate or they had to renew already at higher rates. Half of them haven't, right? They have a fixed rate mortgage. They haven't had to renew yet, or they have a variable rate mortgage with fixed payments. That's still to come. It's still going to be over the next 2 years or so that people will be forced to renew at these higher rates. And so it may be more likely as a home seller that you'll be able to sell your home, but it's not entirely clear that you're going to make a lot more as a result of some sort of galloping out of control house prices as a result of this decrease in rates, or even the expectation that rates will go down further in more decisions in the summer and fall.
You say there's hope that this is the start of a trend. How consistent, I guess, is my question, is the Bank of Canada usually about things like this, right? Is this a signal that it intends, maybe not to get down to zero, but to continue lowering it? Or is it conceivable that they look at the data over the next, 6 weeks, 8 weeks to the next update, and they raise it back again?
I think that's unlikely. They have waited a fair amount, more time probably than they should have, to see this first rate cut. And so the bank generally wants to keep things consistent, either because they're holding rates constant for some period of time or because they're consistently decreasing towards some sort of further goal. I mean, if we saw some sort of dramatic change in the inflation figures or the GDP figures or the employment figures, but I think that as long as things are coming in relatively according to what the bank has projected, that we're not likely to see rates increase. I think we are likely to see them continue to decrease. The one thing that was really interesting in the change between the projections that we saw in April and today was the bank was predicting stronger economic growth, both at the tail end of last year and the first quarter of this year. And we didn't really see that to the same level as they were predicting, or we're in the same kind of very slow, no growth situation that we've been in for the last year or two. Not negative growth, and that's important. I mean, once you get to negative growth, that's a recession. But we haven't seen that negative growth. We haven't seen positive growth. And so certainly the bank has got to be concerned about planting this soft landing that we've gotten so far. We haven't seen negative growth. We haven't seen huge increases in the unemployment rate. It has gone up And that's largely because it has not fully absorbed a huge increase in workers. But they must be being concerned that you don't want to find yourself 2 months from now or 6 months from now in a recession as these interest rates start to bite a lot harder. This has been our experience, is big increases in interest rates yield a recession. We haven't seen that yet this time around, but that's certainly our historical experience in Canada.
Last question then. There's a ton of discussion around interest rates in general today. I'm sure I'm not the only person you're speaking to in the media, and this is happening all over the country. What is one thing that you wish Canadians and people having these conversations today understood about interest rates that you find often missing from the conversation?
Yeah, there's often these very simplistic relationships between interest rates and other things like GDP and inflation that doesn't scratch the surface. We often assume that, we put interest rates up and GDP goes down. That relationship is not at all even, right? Interest rates don't affect all parts of economic growth evenly. It affects some parts very dramatically and affects others not at all. So interest rate hikes, for instance, kills new residential housing construction, kills renovation and the real estate sector. Also car sales, interestingly. But it has no impact on the GDP generated from things like food being sold in grocery stores, which remains one of the big issues. Is that one of the other impacts of high interest rates is we're just not building housing the same way that we should be given the housing crisis.
Right.
And the other piece too is interest. We assume interest rates go up, inflation goes down, as if inflation goes down across all categories. It doesn't. Higher interest rates drives up prices in key areas like mortgage interest and rent costs, which is particularly relevant to an economy like Canada's, where you've got very high debt levels on the household side. On the flip side, high interest rates has no impact on things like food and gas prices, although it does have an impact on house prices. So higher interest rates can drive house prices down. That being said, house prices in the way that we conceive of them as like the Real Estate Association's average house price, it's not actually part of the CPI index. And so looking at beyond the simple relationships that, interest rates up, inflation down, you get a much more interesting picture of what's happening and what some of the solutions could and should be to trying to get affordability under control.
David, thank you so much for this. It's really fascinating to get a more complete picture of what's going on when these headlines hit.
Sure thing. Thanks for having me.
David Macdonald, Senior Economist for the Canadian Centre for Policy Alternatives National Office. Now is the big story. For more from us, you can head to thebigstorypodcast.ca. You can always send us feedback on this episode or any other by emailing us at hello@thebigstorypodcast.ca or calling us and leaving a voicemail 416-935-5935. The Big Story is available wherever you get your podcasts, and it's on smart speakers. Just ask them to play the Big Story podcast. Thanks for listening. I'm Jordan Heath Rawlings. We'll talk tomorrow.